All right, let's dive into what we're calling the impossible catch-up. We're going to break down one of the most critical energy puzzles facing the US right now. It's massive, and I mean massive, uranium supply gap. This really is the story of an impossible game of catch-up. So, how do you solve an impossible equation? Well, let's lay it out. The US nuclear fleet, the reactors that power a huge chunk of the country, needs about 56 million pounds of uranium every single year. But American mines, they produce just 1 million pounds. One. This isn't a gap, folks. It's a chasm.
Okay, so first up, let's talk about the sheer speed of this problem. We're calling this section the demand velocity, because this isn't some temporary hiccup. It's a deep structural supply crisis.
So let's start with this number, 55.9 million pounds. Just let that sink in. That's how much uranium U.S. nuclear operators had to go out and buy in 2024. That's what it takes every year to keep the lights on for tens of millions of us. It's a huge, relentless demand. And now, compare it to this. About 1.1 million pounds. That's the best estimate for what U.S. mines will produce in 2025. You don't even need me to explain it, right? The contrast between that last number and this one, it says everything. And this chart really just drives the point home, doesn't it? Look at that little red sliver at the bottom. That's U.S. production. Now look at those huge bars towering over it. That's everything the U.S. has to import. In 2024, our own mines covered just 1.2% of what we needed. 1.2. That means we're almost completely dependent on other countries. So you've got this massive 98% supply gap. The logical next step, you'd think, is to fire up all the old mines, right? The race is on to find these domestic sources. But here's the million-dollar question. Are all those old sources created equal? Which brings us right to our next section, the San Rafael reality check. We're going to look at this district in Utah. Now, it's got a history. People have mined uranium there before. So on the surface, it looks like, hey, maybe this is part of the solution. But when you dig in, it's a serious reality check. This is what you might call a flawed solution. Okay, check this out. This visual sums up the whole problem perfectly. On the left, you've got ore grade. Basically, how much good stuff, how much uranium is actually in the rock. As you can see, San Rafael's is pretty low. Then on the right, you've got the cost to dig it up. And guess what? San Rafael's is way up there, super high. Low grade and high cost. That's like the worst combination you could possibly have in mining. And hey, don't just take my word for it. This quote is pulled directly from a confidential investment thesis from February 2026. It's pretty blunt. The San Rafael Uranium District is not a priority investment zone. It goes on to say it has an unfavorable risk-return profile. In plain English, the risk is way too high for the potential reward. So you're probably asking, why is it so bad? Well, the analysis breaks it down into 5 big reasons it just fails. First, the grade is just fundamentally too low. We're talking about having to dig up 400 tons of rock just to get 1,000 pounds of uranium. Think about that. Second, the total amount of uranium there is just tiny compared to the big league mines. Third, the operating costs, through the roof. Fourth, it's super sensitive to the market. If the price of uranium dips even a little, you're in trouble. And finally, the cheapest way to mine, this method called ISR, it's just not viable there. The geology won't allow it, so it's a total non-starter from almost every angle. All right, so the geology itself is pretty much a dead end, but let's just pretend for a second you could solve that. There's an even bigger question looming. What about the economics? And that brings us to our final section, the economic dead end. See, San Rafael isn't just a tough place to mine. It's what Wall Street would call a value trap. Something that looks cheap and available, but there's a very good reason for that. And this chart right here shows you exactly why. See that red band? That's the break-even zone for San Rafael. That's the price range, between $50 and $65 a pound, where they're just barely covering their costs. Now look at the price of uranium. Yeah, it's been high lately, but it has repeatedly dropped right into that danger zone. Just in March of 2025, it hit $64. That's living on a razor's edge. There's zero room for error. One little dip in the market, and boom, the whole thing is underwater. To really put this in perspective, let's look at a tale of two mines. We'll compare San Rafael to the kind of mining that actually works in the US today, like the ISR operations in Wyoming. The cost difference is it's night and day. A Wyoming mine can pull uranium out of the ground for maybe $20 to $35 a pound. San Rafael, their costs start at $50 to $65. The only thing it has going for it is a little bit of vanadium on the side. If you're looking for uranium, the choice here is a no-brainer. And that really leads us to the final verdict from the analysis.
The best way to think about San Rafael? It's not a uranium mine. It's a vanadium prospect that just happens to have a little uranium credit. The uranium is just a bonus. It's not the main event. And that completely changes how you look at its value.
So we're back where we started. The U.S. uranium gap is huge, it's real, and it's a serious problem. But what this deep dive shows is that the easy answer, just reopening old mines, isn't an answer at all. It's a value trap. So if chasing these historical ghosts is the wrong move, that leaves us with the biggest question of all. Where does the real solution lie?